Welcome back to PipsTalk, where we guide you through the intricate world of Forex trading. In today's video, we're delving into an important topic: common mistakes to avoid in Forex trading. Forex trading is both an art and a science, but it's also a place where even seasoned traders can make costly errors. Let's explore these pitfalls so you can steer clear of them. 1. Lack of proper education. One of the biggest mistakes in Forex trading is diving in without proper education. Why education matters. Forex trading is complex, and it's crucial to understand the market's dynamics, strategies, and risk management principles. Trading without education is like navigating uncharted waters without a map. Avoidance tip. Invest in learning. Before trading with real money, invest in your education. There are plenty of resources available, from online courses and books to demo accounts. Learn the basics and build a strong foundation. 2. Neglecting risk management. Risk management is the backbone of successful trading, yet many traders overlook it. The risk management blunder. Neglecting risk management can lead to catastrophic losses. It's the equivalent of going all in at a casino without knowing the odds. Avoidance tip. Implement proper risk management. Set stop-loss orders, adhere to position sizing rules, and never risk more than you can afford to lose in a single trade. Consistency in risk management is key. 3. Emotional trading. Emotions often run high in Forex trading, and letting them dictate your decisions is a recipe for disaster. The emotional pitfall. Emotional trading leads to impulsive decisions, like revenge trading after a loss or overconfidence following a win. Avoidance tip. Create a trading plan. Develop a trading plan with clear entry and exit points. Stick to your plan regardless of emotions. If emotions are running high, step away from the computer and reevaluate. 4. Overleveraging. Overleveraging is a tempting but perilous path. The overleveraging snare. Using excessive leverage can amplify gains, but it also magnifies losses. It's like playing with fire, it can quickly burn your account. Avoidance tip. Use leverage wisely. Limit your leverage to a manageable level. A conservative approach often serves traders better in the long run. 5. Neglecting fundamental analysis. Some traders focus solely on technical analysis, neglecting the importance of fundamental analysis. The neglected fundamentals. Ignoring economic events, central bank policies, and global news can leave traders blindsided by unexpected market moves. Avoidance tip. Combine technical and fundamental analysis. Incorporate both technical and fundamental analysis into your trading strategy. This comprehensive approach can provide a clearer picture of the market. 6. Chasing the market. Chasing the market is a common mistake, especially for those who want to catch every price move. The chasing pitfall. Chasing the market often results in entering trades too late, with less favorable risk-reward ratios. Avoidance tip. Patience is key. Avoid impulsive entries. Be patient and wait for setups that align with your strategy. It's better to miss a trade than to enter one recklessly. 7. Ignoring stop-loss orders. Stop-loss orders are essential for risk management, yet some traders ignore them. The neglected stop-loss. Not using stop-loss orders can lead to catastrophic losses if a trade goes against you. It's like driving without a seatbelt. Avoidance tip. Always set stop-loss orders. No matter how confident you are in a trade, always set a stop-loss. It's your safety net in the unpredictable Forex market. 8. Not keeping a trading journal. Not keeping a trading journal is a missed opportunity for improvement. The trading journal oversight. A trading journal helps you track your performance, identify patterns in your trading behavior, and learn from your mistakes. Avoidance tip. Maintain a trading journal. Record your trades, your reasoning, and the outcomes. Review your journal regularly to make informed adjustments to your strategy. 9. Trading without a clear strategy. Trading without a clear strategy is like sailing without a destination. The strategy vacuum. Some traders enter the market with no defined strategy, relying solely on gut feelings. Avoidance tip. Develop a trading strategy. Craft a well-defined trading strategy with clear entry and exit rules. Stick to your strategy consistently. 10. Overtrading. Overtrading is a common error among traders eager to be constantly active in the market. The overtrading dilemma. Excessive trading can lead to exhaustion and poor decision-making. It's like running a marathon without pacing yourself. Avoidance tip. Set limits. Set daily or weekly trading limits to avoid overtrading. Quality is often more important than quantity in trading. In conclusion, avoiding common mistakes in Forex trading requires education, discipline, and self-awareness. Remember, even seasoned traders make mistakes, but the key is to learn from them. If you found this video helpful, please subscribe to PipsTalk for more insights into Forex trading, strategies, and risk management.